Welcome back to another deep dive. All right, let's just jump right in. When you think of a convenience store, what springs to mind?
Probably gas, right? A quick fill-up.
Yeah, exactly. Gas, maybe grabbing a quick snack, maybe a lottery ticket if you're feeling lucky.
Sure, the usual stuff.
But what if I told you there's a company that's not just transforming that whole idea, but is actually becoming a genuine powerhouse? And kind of surprisingly, one of the biggest pizza chains in the entire U.S.
It sounds a bit counterintuitive, doesn't it? The convenience store being a major pizza player.
It really does. Today we're doing a deep dive into exactly that company, Casey's General Stores, Inc. They trade on Nasdaq under the ticker CSSY.
Right, headquartered out in Ankeny, Iowa.
Yep. And they operate, give or take, around 2,900 stores across 19 states, primarily, focused in the American Midwest.
A big footprint, especially in that part of the country.
So our mission for this deep dive is pretty clear. We're going to unpack Casey's really unique business model. We'll analyze its impressive financial strength, its strategic growth plans.
And also, crucially, confront the significant challenges it faces, especially, in a world that's changing so fast around them.
Yeah, it's about extracting those crucial nuggets of knowledge, trying to really understand what makes this company tick and, well, what its future might hold.
And what's truly fascinating about Casey's, I think, is how they've managed to carve out this remarkably defensible market position, particularly by really targeting those rural and small-town communities.
Places maybe others overlook.
Exactly. It's almost a masterclass in strategic niche development that, bigger players have often ignored. We're going to explore their innovative three-pronged revenue structure. You've got fuel, prepared food and dispensed beverages, and then grocery and general merchandise.
And the pizza part, you weren't kidding about that.
Not at all. Their pizza program is so substantial it actually makes them the fifth largest pizza chain in the United States by kitchen count.
Wow. Okay. That's a stat.
It is. But beyond just the operational brilliance, which is considerable, we're also going to connect this to the bigger picture, these broad industry shifts happening and what that really implies for their future performance.
Right.
And this raises a really important question, I think, for you, our listener, today. Can a company that's still so reliant on one core business, fuel, truly adapt and thrive when faced with these profound, long-term industry shifts, like the accelerating transition to electric vehicles?
That's a big one.
It really is. That's kind of the central tension we'll be dissecting throughout our conversation today.
Okay, so let's get into it. How exactly does a chain of convenience stores, especially one so deeply rooted in smaller towns, achieve the kind of, record financial performance we've actually seen from Casey's?
Yeah, how did they pull it off?
It seems to start with their business model, right, which they've truly refined into something. Well, you called it the modern general store. It sounds like it's far more complex and synergistic than just, your typical corner gas station.
It absolutely is. And the brilliance of Casey's model really lies in that synergistic approach. Each of those three core segments we mentioned isn't just a standalone offering. They actively support and enhance the others. It's quite integrated.
Okay, so break that down for us. Where does it start? Fuel.
Let's start with fuel. Yes. Now, this is the primary driver of their total revenue. Just to put some numbers on it, in fiscal year 2025, fuel sales alone generated $9.8 billion in revenue.
Billion with a B. Wow.
Yeah, which accounted for roughly 61% of their total top line. Huge chunk. However, and this is key, it's also their lowest gross margin business.
Okay, so lots of dollars coming in, but not necessarily the most profitable dollars.
Exactly. Fuel contributed about $1.24 billion in gross profit, which sounds like a lot, but it's only about 33% of their total gross profit. So the key insight here is that while fuel sales are relatively low margin, their strategic role is as this powerful customer acquisition tool.
The magnet, basically.
Precisely. Think of it as the initial magnet that draws vehicle traffic to their locations, creating that, the crucial first touch point with the customer. Get them onto the lot.
So fuel brings people to the pump, makes sense. But given those lower margins you mentioned, how crucial is it really for Casey's overall profitability? Or is it more like, just necessary cost of doing business to get customers on the property? What's the true profit driver once they've got people there?
That's a critical question, and it leads us perfectly into the second segment, prepared food and dispensed beverages, or PF&DB as they call it.
Touchy acronym.
Isn't it? This is Casey's key strategic differentiator. And fundamentally, it's their most significant profit engine, certainly on a margin basis.
Okay, this sounds important.
It really is. In fiscal 2025, this PF&DB segment generated $1.6 billion in revenue. But here's the kicker. It did so at an incredibly impressive gross margin of 58.2%.
Whoa.
Yeah.
58% compared to fuel's margins. That's huge.
Yeah. Massive difference. And their offerings here, which notably include their, famous made-from-scratch pizza, that's a real standout, along with things like hot sandwiches, bakery items, dispensed drinks. They create this powerful destination appeal.
So people aren't just grabbing food because they're already there for gas?
Exactly. This isn't just an add-on, it's a core draw. It allows Casey's to effectively compete head-to-head with quick-service restaurants, QSRs, in the communities they serve.
Like actual fast food places.
Absolutely. And what's truly surprising and really speaks to the success of their kind of food-first strategy is the data. Approximately 75%, three-quarters of all inside store transactions do not include a fuel purchase.
Get out. Really? 75%?
Yep. Which means people are actively visiting Casey's specifically for the food, independent of whether they need gas or not.
That completely flips the script on the typical convenience store model.
It really does. It's what you could call a compelling dual attraction model, where the store itself, because of the food, becomes a destination, not just a place you stop on the way somewhere else.
Okay, that's a profound shift. It's less a gas station that happens to sell some food and more like a food destination that also offers gas and, other convenience items.
Precisely. And that brings us to the third leg of this operational stool.
Right, the more traditional stuff.
Exactly. The third segment is grocery and general merchandise. This provides all those traditional convenience items you'd expect. Snacks, beverages, tobacco products, maybe some household staples.
The things you run out of late at night.
Exactly. Milk, bread, things like that. In fiscal 2025, this segment contributed a significant $4.1 billion in revenue, and it operated at a pretty healthy 35.0% gross margin. Not as high as prepared foods, but certainly better than fuel.
Still pretty good.
Definitely.
Yeah.
And a significant initiative here, something they're pushing, is the expansion of Casey's private label offerings.
Store brands.
Right, which provides a value-oriented alternative for their more price-sensitive consumers. And it also helps to enhance the segment's overall margins. Better profits on those private label goods.
Makes sense. So that rounds out the convenience factor.
It does. This segment reinforces the overall convenience aspect and contributes steadily to that inside store profitability. So when you look at it all together, the synergy across these three segments creates this really resilient revenue base.
Because they're not totally reliant on any one thing.
Exactly. It effectively hedges against volatility in any single sector. They're not solely dependent on, say, the fluctuating price of fuel, which can be wild, or the declining demand for tobacco. They've diversified their income streams and created multiple compelling reasons for a customer to actually visit their stores.
Okay, so that diversified income stream effectively de-risks their reliance on any single volatile product like fuel. That makes a lot of sense. Now let's talk geography. Most big chains, they chase the bustling city centers, right? Battling it out for prime real estate market share.
Yeah, high traffic corners.
Right. But Casey's made this very strategic decision to go rural. How exactly has this seemingly counterintuitive move paid off so well, especially, in terms of creating a real competitive advantage?
Well, their strategic foundation is built on that deliberate focus, dominating smaller rural markets, places where the competitive landscape is just far less intense.
Less sharks in the water.
Pretty much. Roughly 71% of their stores are located in towns with populations under 20,000 people. And even more striking, a remarkable 50%, half their stores, are in communities with fewer than 5,000 residents.
Wow, really small towns.
Tiny towns in some cases. This concentration is their formidable geographic moat, as you might call it. It effectively insulates them from the fierce, direct competition you see in those more saturated urban and suburban markets where, larger C-store chains and other big retailers are aggressively competing for every single customer.
So they essentially become the convenience store, the pizza place, the quick stop in many of these towns.
Often, yes. They become the dominant, sometimes the sole player in these communities. It's a powerful position.
So by choosing a less crowded battlefield, they've kind of become the undisputed champion in their chosen arenas. But it's not just about the towns themselves, is it? I remember reading their real estate strategy plays a massive role in building this unique moat.
Oh, absolutely critical.
Yeah.
And it's a profound differentiator that builds serious long-term value. Casey's owns the vast majority of its properties. We're talking both the land and the buildings.
Which is unusual in retail, right? A lot of chains lease.
Very much so. And this ownership approach yields several distinct advantages. Financially, obviously, it provides substantial flexibility, but it also creates this significant and often quite understated real estate asset right there on their balance sheet.
Understated how?
Well, as of July 2024, the net book value of their property and equipment was $4.7 billion. Now, book value is based on historical cost minus accumulated depreciation. In a generally rising real estate market like we've seen over the long term, this book value often significantly understates the current market value of such an extensive portfolio.
Got it. So they're likely sitting on even more asset value than the official numbers show, a kind of hidden asset then.
Exactly. You could think of it that way. Operationally, owning their properties also significantly lowers their cost structure because they eliminate rent expenses. And rent is a major operating cost for many, many other retail peers who lease their locations.
That's a big structural advantage day in, day out.
Huge. And this ownership model also becomes a powerful strategic weapon in their mergers and acquisitions, or M&A, strategy.
How so?
Well, when they're looking at buying smaller operators, who often do lease their locations, Casey's can underwrite that acquisition with a lower ongoing operating expense assumption. Why? Because they won't have to pay rent on those acquired properties once they own them.
Ah, so they can afford to pay a bit more or just make the deal more profitable for themselves right off the bat.
Precisely. It enables them to potentially offer a competitive price for acquisitions while still achieving their internal return on invested capital, their ROIC targets. And furthermore, this extensive portfolio of owned real estate, it serves as high-quality collateral.
Meaning cheaper loans.
Exactly. It grants them access to low-cost debt, which in turn fuels their ambitious growth plans, like building new stores or making more acquisitions. So it creates this self-reinforcing cycle. Superior operations, partly enabled by that real estate ownership, generate cash.
Which they use to buy or build more stores, often leveraging the properties they already own.
Which then generate more cash. It's a unique advantage compared to many of their peers who are constantly paying rent.
That's a truly clever long-term strategy. They're essentially building equity and fueling growth simultaneously, creating this physical fortress that actually helps them expand. It sounds like they've really cracked the code on scaling in a sustainable way.
It's a powerful and, frankly, often overlooked aspect of their business success. It's not just about selling pizza and gas. It's about the fundamental assets they own and how they strategically leverage them for enduring advantage.
Okay, so they have a smart business model, this great location strategy, leveraging their real estate. But let's get down to the store level. How do these individual stores actually perform day to day? Well, what are the numbers telling us about their efficiency and, their ability to grow even when the economy gets tough? Let's dive into the unit economics.
Yeah, this is where their operational discipline really, really shines. And we typically look at three key areas here: same-store sales, margin profile, and operational efficiency.
Okay.
Let's start with same-store sales, or SSS. Think of this as the company's report card for its existing locations, right?
The ones that have been open a while.
Exactly. It measures growth at stores that have been open for over 1 year, and it's a critical indicator of the underlying health of the business beyond just, adding new locations through building or buying.
So how are they doing there?
Pretty well, actually. In fiscal 2025, Casey's delivered positive inside SSS growth of 2.6%. And that was building upon a really strong 4.4% growth in the prior year, fiscal 2024.
So consistent growth even as things may be tightened up economically.
Right. It demonstrates the business's resilience, even in what's been a challenging consumer environment recently. And the key driver for this growth, it was a 3.5% increase in their high-margin prepared food and dispensed beverages category.
The food again.
The food again. It really proves the success of that food-centric strategy. People are coming in and buying more of the profitable stuff.
So their inside sales are clearly driving growth. Does this mean fuel sales are becoming less relevant or just less of a growth driver specifically?
That's a crucial distinction, I think. In contrast to those strong inside sales, same-store fuel gallons sold remained relatively flat. They showed only a tiny 0.1% increase in fiscal 2025.
Basically flat.
Basically flat, which indicates that the company's overall growth is being driven primarily by performance inside the store and, of course, the contribution from adding new units, both built and acquired. They're not just riding the waves of fuel price fluctuations for growth.
Right. The fuel segment still brings in revenue, brings in customers, but the growth story and the profitability story are increasingly centered indoors.
You've got it. That's a clear sign of a successful strategic pivot. They're growing where the profits are highest.
Which makes perfect sense.
Yeah.
So how are those profits, the margins, looking overall?
Moving to their margin profile, a key focus for management has absolutely been the expansion of what they call the blended inside margin.
Okay, what's that?
It basically combines the gross margins from the prepared food and dispensed beverages segment and the grocery and general merchandise segment. So everything's sold inside, blended together.
Got it. The overall profitability of the inside of the store.
Exactly. And this metric has shown a really clear positive trend. It's steadily climbed from 39.9% back in fiscal 2023 up to 41.0% in fiscal 2024, and then further to 41.5% in fiscal 2025.
So they're getting more profitable on every dollar sold inside?
That's right. And this expansion is a direct result of two things. First, that favorable sales mix shift towards those higher margin prepared foods we keep talking about.
People buying more pizza and sandwiches.
And second, coupled with effective cost of goods management. They're controlling their input costs well. Even their fuel margins, while they are inherently volatile, have remained quite robust. They averaged a healthy 38.7 cents per gallon in fiscal 2025.
Which is pretty good for fuel.
Very solid. Yeah. So consistently improving margins, especially on the inside, really underscore management's discipline and, again, the success of that critical PF&DB segment.
So better margins on more sales inside the store. That's a powerful combination for profitability. But how are they achieving such exceptional control over their operating expenses, especially with, rising labor costs hitting everyone? What's their secret there?
Yeah, that's the other side of the coin, right? And it leads us to operational efficiency, which is frankly a standout characteristic of CASY's management team. They have exceptional control over their operating expenses, or OPEX.
How exceptional?
Well, consider this. Despite significant wage inflation across the entire retail sector, their same-store operating expenses, and this is excluding credit card fees, which can fluctuate, increased by a really modest 1.7% in fiscal 2025.
Only 1.7%, with wages going up way more than that.
Exactly. It's an impressive feat. And it was achieved primarily through a 2.4% reduction in same-store labor hours.
Ah, they're getting more efficient with staffing.
Precisely. This points directly to the successful implementation of technology and process improvements that are designed to enhance productivity and streamline operations within the stores.
So using tech to do more with less labor time.
That seems to be a big part of it. And this operational efficiency, this tight cost control, is a crucial and often kind of overlooked driver of their consistent earnings beats and their margin expansion. It creates powerful operating leverage.
Meaning more profit drops to the bottom line as sales go up.
Exactly.
Yeah.
It allows a greater portion of every gross profit dollar to actually fall to the bottom line. It's a testament, I think, to their really granular focus on the smallest details of store operations. They sweat the small stuff.
Okay, so they're performing well internally, they're managing costs tightly, growing profitably inside the store, but, no business exists in a vacuum. What's the bigger picture here? What does the U.S. convenience store market look like overall, and how does CASY's really stack up against its rivals? Who are they truly competing with in this rapidly evolving landscape?
That's right. You have to look at the context. The U.S. convenience store industry is, it's vast and it's dynamic. Globally, it's estimated at over $2 trillion, believe it or not.
Wow.
And projections are for steady growth. 5% to 6% compound annual growth rate, or CAGR, going forward.
What's driving that growth?
It's driven by enduring consumer demand for convenience, which seems perpetually strong, increasing urbanization in some areas, but critically, also a strategic industry-wide expansion of food service offerings. More C-stores are trying to be like CASY's, essentially.
Trying to catch up on the food front.
Trying to catch up. Now, a defining characteristic of this industry, especially in the U.S., is its fragmentation. Independent, single-store operators still account for the majority of establishments.
Lots of mom-and-pop shops.
A huge number.
Yeah.
This structure, however, creates a significant opportunity for well-capitalized, scaled operators like CASY's.
Because the smaller guys are struggling.
Increasingly, yes. Smaller players are more challenged by rising operating costs, those persistent labor shortages we talked about, and also the substantial capital investment required to compete effectively in areas like technology, digital loyalty programs, and especially fresh food programs.
It's expensive to build a kitchen.
Very. This pressure creates a really favorable environment for consolidation, and Casey's is clearly well-positioned and actively capitalizing on this trend.
So it's a big market, growing, but one where larger, more efficient players like Casey's can increasingly acquire and integrate the smaller ones. How does Casey's unique modern general store concept, with its food focus and that rural strategy, actively defend itself against these broader market dynamics? What are those moats again?
Yeah, let's reinforce those competitive advantages, those moats. Their most distinct moat, as we discussed, is their geographic dominance in rural markets. Remember, an estimated 83% of Casey's stores are in rural areas.
That's way higher than competitors.
Way higher. Compare that to Murphy USA at 65%, or someone like 7-Eleven, which is only around 28% rural. This deliberate strategy really limits direct head-to-head competition with other large C-store chains that tend to cluster in those more densely populated urban and suburban corridors.
Right, they're not fighting tooth and nail on every city corner.
Exactly. They're often the big fish in a smaller pond, which just fundamentally reduces competitive friction and pricing pressure.
And their pizza program is a big part of that moat too, right?
Yeah.
How does that factor in competitively?
Oh, absolutely. That's the second key moat. Their pizza and prepared foods differentiator. Their food service program isn't just good, it's a powerful competitive weapon. As we said, recognized as the fifth largest pizza chain in the U.S. by kitchen count.
Still amazing.
It means Casey's functions, effectively, as a quick service restaurant, a QSR, that happens to be embedded within a convenience store. It's not just a C-store selling incidental food items. It truly is a food destination in its own right in many of these towns.
So it drives trips specifically for meals.
Exactly. It drives dedicated customer trips, commands exceptional brand loyalty. I saw a stat about 92% top-of-mind aided awareness in its core markets, which is incredible for a convenience store. And crucially, it generates those superior gross margins that are so vital to their overall profitability.
92% awareness is huge. And there's a third moat too.
Yes, the third one is their vertical integration and scale. Their operational infrastructure provides a significant cost and efficiency advantage that smaller players just can't match. They operate 3 of their own large distribution centers.
Supplying most of their own stores.
Yep, these centers supply approximately 70% of their in-store products. And they also maintain a private trucking fleet that delivers roughly 60% of their own fuel.
So they control a lot of their own logistics.
The huge amount. This vertical integration gives Casey's much greater control over its supply chain, helps ensure product availability, which is key, and allows them to efficiently service their geographically dispersed rural store base. That's a capability that smaller, independent competitors simply cannot replicate cost-effectively.
Right. Delivering to tiny towns can be expensive if you don't have scale.
Very expensive. So these moats, they don't exist in isolation, right? They form this reinforcing system where the high profits from food get reinvested into things like technology, supply chain enhancements, maybe better store layouts,
which makes them even more efficient and appealing.
widening the gap with smaller competitors and creating this virtuous cycle of market share gains and consolidation.
It sounds like they've really thought through every aspect of their business, from distribution right down to the customer experience with the pizza, to create a really sustainable competitive advantage. So, given all that, who are their actual competitors today in this expanding and evolving landscape? Are we just talking about other C-stores, or is it something broader now?
It's definitely becoming a more diverse set of players.
Yeah.
And yeah, the definition of their peer group is absolutely expanding. If we look at direct C-store competitors, the most comparable publicly traded peer is probably Murphy USA, ticker MUSA.
Okay, we mentioned them. How do they compare?
Well, Murphy USA is primarily a fuel-centric, value-driven operator. Most of its locations are strategically placed near Walmart stores. MUSA has a much more limited food service offering compared to Casey's, and geographically they're more concentrated in the southern U.S. So it's a pretty clear contrast in strategy and focus.
Different models.
Very different models. Then you have several large, highly respected private chains. Think Quick Trip, Wawa.
Yeah, those guys have great reputations.
They really do. They're often regarded as best-in-class operators, known for strong company cultures, high efficiency, and really high-quality food offerings. Now, historically, their geographic footprints have had somewhat limited overlap with Casey's core Midwest markets, but
That they're growing.
all of them are in expansion mode, which means future overlap and increased competitive pressures in shared territories are, frankly, inevitable over time.
Okay, so they're not just competing with other gas stations, but also with these highly regarded, food-focused convenience stores that are also expanding.
Yes, exactly. And beyond that direct C-store competition, the competitive threat is broadening considerably. We have to talk about indirect competitors, where the lines are really blurring.
Like who?
Think dollar stores, like Dollar General, and large format retailers, like Walmart itself. Both are aggressively expanding their grocery and convenience offerings, particularly in the rural markets that have traditionally been Casey's stronghold.
So Dollar General selling milk and bread is a direct hit.
It can be, yeah. And furthermore, the entire universe of quick service restaurants, your McDonald's, your Subways, your local pizza joints, and even third-party food delivery services like DoorDash or Uber Eats, they all compete directly with Casey's high-margin prepared food business.
Right, if someone wants pizza, they have more choices than ever.
Exactly. This blurring of competitive lines means Casey's really must be analyzed not just against other C-stores, but almost as this hybrid retail and QSR entity. And understanding that hybrid status helps to contextualize, maybe even justify, its premium valuation relative to those more fuel-focused peers like Murphy USA.
All right, this is super helpful context. We've covered the strategy, the operations, we've seen how they're growing inside the store, and highlighted their frankly fantastic competitive advantages. Now let's talk money. How has all this operational success actually translated into their financial performance? And how disciplined are they really with managing their capital? Because ultimately, as you said, that's what truly matters for long-term shareholder value.
You're absolutely right. The financial scorecard is critical. And Casey's has delivered a really strong and notably consistent financial performance over the past several fiscal years. Let's look at some key numbers.
Let's do it.
Total revenue first. It increased by 7.3% in their fiscal year 2025, reaching $15.9 billion. That was up from $14.9 billion in fiscal 2024.
Almost $16 billion in sales. Pretty significant.
Very. And this top-line growth was primarily driven by a really robust 10.9% increase in total inside sales. So that includes both existing stores and the contribution from acquired stores. This strong inside performance successfully offset the impact of those fluctuating retail fuel prices on the total revenue number.
That's impressive growth inside, especially when fuel prices can swing wildly and distort the total revenue picture. They're clearly finding ways to grow beyond that volatility.
It's exactly right. And their margin evolution is particularly noteworthy, as we touched on earlier. That blended inside gross margin, the key indicator of their inside profitability, has steadily climbed. Remember, it went from 39.9% in fiscal 23 to 41.0% in 24, and then nudged up again to 41.5% in fiscal 25.
Consistent improvement year after year.
Yeah, really solid trend. And this consistent improvement is a direct result of the company's strategic emphasis on its high-margin prepared food offerings, plus that disciplined cost management on the goods they sell. Their overall EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, a core measure of operational profitability, has also shown strength.
Yeah.
It expanded from 7.1% in fiscal 24 to 7.5% in fiscal 25.
Which suggests that operating leverage you mentioned earlier is kicking in.
It does. It reflects growing operational leverage as they scale the business. More sales, better margins, controlled costs.
So better margins on more sales. How does that translate down to the bottom line, the actual net income, and maybe more importantly, their cash flow?
Good question. This growth and margin expansion have translated directly to robust profitability and cash flow. Net income grew by a strong 8.9% to hit a company record of $546.5 million in fiscal 2025.
Over $500 million in profit.
Yep. Diluted earnings per share, or EPS, which is what investors often focus on, followed suit. It rose 9.0% to $14.64 per share. And the business is a strong generator of cash. Cash flow from operations reached $1.1 billion in fiscal 2025.
Over $1 billion in operating cash flow. That's serious money.
It is. And looking at free cash flow, which is the cash left over after capital expenditures, for the trailing 12 months ending then, it stood at a healthy $584.6 million. That provides substantial resources for both reinvestment back into the business and returns to shareholders.
So consistent, strong performance, impressive margin expansion, even in an inflationary environment, it really sets them apart.
It really does.
Okay, so strong cash flow is obviously the lifeblood of any growing business. What's their philosophy when it comes to actually deploying all that capital? How do they decide where to put their money to get the best effect? Is it growth? Is it dividends? Buybacks?
It's a mix, but they employ a very balanced and, I'd say, disciplined capital allocation strategy. You can almost picture it as a flywheel that keeps turning.
Okay, explain the flywheel.
So the primary use of capital, priority one, is to fund high-return growth investments. Their current strategic plan aims to add over 350 new stores between fiscal 2024 and 2026, so significant unit growth.
How do they add those stores? Building new ones?
Buying. It's a dual approach, both new store construction, building from the ground up, and strategic mergers and acquisitions. And on the M&A front, they recently made a big splash with the acquisition of the 198-store CEFU chain from Fikes Wholesale.
It was the biggest ever, right?
Largest in company history, yeah. It really showcased their capacity for executing large-scale M&A. But whether building or buying, management maintains really strict investment criteria. They target double-digit returns on invested capital, or ROIC, for these new store projects.
So every dollar they put in, they expect to get a significant return back quickly.
That's the goal. For instance, their capital expenditures or CapEx guidance for fiscal 2026 is around $600 million, reflecting this continued commitment to growth investment.
Okay, so growth is priority number one, fueled by strong internal returns. Makes sense. But what about the shareholders directly? Do they see a return beyond just the growth of the company itself?
Absolutely. Casey's has a long and very consistent history of returning capital directly to its shareholders. Let's talk dividends. In June 2025, the company announced its 26th consecutive annual increase to its dividend.
26 years straight. That's impressive.
It really is.
Yeah.
They raised the quarterly payout by 14% to $50.57 per share. Importantly, though, the dividend payout ratio, that's the percentage of earnings paid out as dividends, remains quite conservative, only around 14%.
Which means they have plenty of room to keep raising it.
Exactly. It provides ample room for future growth without straining their cash flow. And they also complement that growing dividend with an opportunistic share repurchase program, buying back their own stock.
Reducing the share count, boosting EPS.
Right. For fiscal 2026, the company announced plans for $125 million in share buybacks. So they're returning cash through both dividends and buybacks.
Okay, so they're growing aggressively, paying a rising dividend and buying back shares. How are they managing their debt levels through all this activity? It sounds like a lot of capital going out the door.
That's where the discipline comes in. This balanced approach is really underpinned by a strong commitment to maintaining a healthy balance sheet. As of the end of fiscal 2025, the company's debt-to-EBITDA ratio, that key measure of leverage comparing total debt to operational earnings, was a very healthy 1.9x.
And their target is?
Their long-term target is around 2.0x, so they're comfortably below that. At that time, they also had available liquidity cash on hand plus undrawn credit facilities of $1.2 billion.
So plenty of financial firepower left.
Significant capacity to fund future acquisitions, investments, whatever opportunities arise. So to tie this all back to that flywheel concept you asked about, their resilient core business generates over $1 billion in annual operating cash flow. That cash is first deployed into those high ROIC growth projects. New stores, acquisitions. These new assets in turn generate additional cash flow, feeding the flywheel for future growth. The remaining cash is then allocated to that steadily growing dividend and those opportunistic share buybacks. And the entire process is managed under that disciplined leverage target, ensuring they can pursue growth without taking on excessive financial risk.
That makes sense. It's a cycle.
It is. And I'll just reemphasize, that consistent outperformance on the expense control we talked about, keeping same-store OPEX up only 1.7% in fiscal 2025 is absolutely crucial here. It creates that powerful operating leverage, allowing more profit to drop down, which significantly contributes to their track record of exceeding EPS expectations and keeps that flywheel spinning smoothly.
Okay, so they're disciplined, they're profitable, they've got this great flywheel model generating a ton of cash. But what's next? How are they planning to keep this momentum going and expand their reach even further in the years to come? What are the specific strategic initiatives that will define their future growth trajectory?
Yeah, looking ahead, their growth strategy is clear and it's multifaceted. It leverages both those internal organic initiatives and continued disciplined acquisitions. On the organic growth front, they are really focused on geographic white space expansion.
Finding more towns like the ones they're already in?
Exactly. Management has identified significant opportunities for new store builds within their current 19-state footprint, as well as in adjacent markets they might want to enter. Their strategic sweet spot, as we discussed, remains those towns with populations roughly between 500 and 20,000 people. That's where they feel they can establish that dominant market position.
And how many are they planning to build?
Their stated plan, their guidance, is to open at least 80 new stores in fiscal 2026. So that demonstrates a continued commitment to that organic growth pipeline, building stores one by one. This steady expansion allows them to reach more potentially underserved communities and just replicate their successful model over and over.
So finding those smaller, often overlooked communities and becoming the go-to spot there, that makes perfect sense given their whole rural focus. And what about their food business? That's been so key. How are they planning to keep that growing and innovating?
Yeah, that's another major organic lever, food service innovation. Continuous innovation in that prepared food and dispensed beverages segment remains an absolute top priority for them.
What does that look like? New pizzas?
It includes introducing new menu items, yes. Running popular limited time offers, or LTOs. Remember that BBQ brisket pizza they had?
Right.
That was apparently a big hit.
I bet.
Expanding their offerings across different day parts, maybe more breakfast items, late night snacks, and even testing entirely new food platforms. A notable current initiative is the testing of a chicken wing and fry program in about 225 stores,
Wings and fries. That could be big. How's it doing?
apparently showing encouraging early results, according to management. So the overarching goal here is to leverage this constant food innovation to drive incremental store traffic, give people new reasons to come in, and further expand their highest margin business. This helps solidify their status as a true food destination, which, as we'll discuss later, is absolutely vital for long-term resilience, especially as the industry considers a future with maybe less reliance on gasoline.
That's smart. Keep the menu fresh, give people new reasons to come in specifically for food, and then they'll probably grab other things too while they're there. And their loyalty program, CASY's Rewards. That sounds like it must be a big part of that engagement strategy.
Oh, it's the cornerstone of their digital engagement strategy and, yeah, a powerful tool for organic growth. The CASY's Rewards program has achieved significant scale. They grew to over 9 million members by the end of fiscal 2025.
9 million members. That's huge for a regional chain.
It's a massive base, and its strategic purpose is clear. Increase customer loyalty, drive more frequent visits, and raise the average transaction size. How? Through personalized marketing, targeted promotions based on purchase history, and exclusive value offerings just for members.
Does it work? Do members actually spend more?
Company data confirms it. Rewards members visit more frequently and spend more per transaction than non-members. So it clearly validates the program's effectiveness, and it also provides this incredibly rich data set for further insights into customer behavior.
That's a huge database of engaged customers they can leverage for marketing and menu development.
Okay, so that's the organic side. Beyond that, you mentioned they're also a disciplined acquirer. How does M&A play into their future growth?
Yes, inorganic growth through that disciplined acquisition strategy is another major pillar. And Casey's has a really proven track record as an effective acquirer. As we noted, they acquired 235 stores just in fiscal 2025 alone. That included that landmark 198-store CEF's Go chain acquisition.
So they're actively buying up competitors.
Very actively. And management has noted that the pipeline for potential M&A remains robust. Why? Because those economic pressures we talked about continue to mount on smaller independent operators, making them potentially more receptive to selling.
So they're ready to scoop up distressed or maybe just less efficient competitors. But it's not just about buying the stores, right? It's about what they do with them after the acquisition. How do they ensure these deals are truly accretive, that they actually add value to the business? Precisely. Integration is key. Their M&A playbook is really centered on synergy realization. They acquire these underperforming or maybe strategically complementary chains, and then they apply Casey's superior operational model to drive better returns.
What kind of synergies are we talking about?
Key sources include things like introducing their high-margin Casey's Kitchen program into acquired stores that might not have had a strong food offering before, leveraging their scale supply chain and fuel sourcing capabilities to reduce costs at the acquired locations, and, crucially, integrating the new locations and their existing customers into that powerful Casey's Rewards loyalty program.
Getting those new customers onto their digital platform.
Immediately. Management's model targets the full realization of all these synergies by the 4th year following an acquisition. So they have a clear timeline. And it's really important to emphasize the intertwining of their digital strategy and their M&A strategy here. The rewards program is absolutely critical for maximizing the value of those acquired stores. It provides the data, it allows them to influence customer behavior right away.
So they buy a chain, maybe one with a weak loyalty program?
Right. And they can immediately launch targeted marketing campaigns to that existing customer base, encouraging them to enroll in Casey's Rewards, offering them deals, thereby accelerating the path to achieving those revenue and profit synergies.
That's smart integration.
Very. And one last point on growth. Their guidance to open at least 80 stores organically in fiscal 2026. That appears potentially conservative.
You think they'll do more?
Well, consider they added 270 total units, including acquisitions, in fiscal 2025, and they have a strong balance sheet with over $1.2 billion in liquidity. It suggests the company is well-positioned to potentially exceed this baseline guidance, likely through additional bolt-on acquisitions that might not even be factored into current consensus analyst estimates yet. There could be upside there.
Okay, interesting. Now, we've painted a pretty rosy picture, focusing on the strengths and growth. But every success story has its hurdles. For all their operational excellence and clever strategies, what are the biggest speed bumps Casey's is navigating right now? What are the key risks that might, keep management up at night in an industry that's always in flux?
That's a crucial perspective to bring in, yes, to balance the optimism. Because despite their clear strengths, Casey's absolutely faces a confluence of macroeconomic, industry-wide, and longer-term secular risks.
Okay, let's break those down. Where do we start? Macro.
Let's start with the macroeconomic and industry-wide risks. First and foremost, inflationary pressures. Inflation presents this multifaceted headwind.
How does it hit them?
Well, directly, rising commodity prices impact profitability. For instance, management actually called out an increase in the cost of cheese, a key pizza ingredient, from $2.12 to $2.25 per pound in just one quarter. That created a direct headwind on their prepared food margins.
Little things like cheese prices add up fast.
They really do when you're making that much pizza. But inflation also affects consumer behavior. Persistent inflation is impacting wallets, right? It's causing some shoppers to maybe reduce their convenience store visit frequency or decrease their basket sizes when they do visit. We're also seeing a shift towards lower-priced private label brands.
Trading down.
Trading down. And there's even a risk of a broader consumer pullback, with some consumers potentially replacing C-store trips entirely with visits to grocery stores or dollar stores just to save money. And of course, tied into inflation is labor costs. Wage inflation continues to be a major challenge across the entire retail and service industries, including for Casey's.
So external economic forces are definitely a concern, even for a company that runs as efficiently as Casey's. What about the fuel market itself? It's still their biggest revenue driver, even if it's not the profit driver.
Indeed. Fuel market volatility is another significant risk factor. While Casey's has very strategically shifted its focus toward growing inside store sales, fuel gross profit still remains a major contributor to its overall earnings, and those profits are inherently unpredictable.
Because oil prices bounce around.
Exactly. They're subject to the volatility of global crude oil markets, geopolitical events, domestic supply and demand dynamics, things totally outside Casey's control. A prolonged period of sharply compressed fuel margins could have a material adverse effect on the company's profitability, no question.
Okay. And what about labor beyond just wages? Finding people, keeping them.
Yeah, the broader labor market dynamics. The convenience store industry, unfortunately, is characterized by extremely high employee turnover rates. One study put the average at 141% back in 2022.
Wow. That means turning over your entire staff almost 1.5 times a year?
It's incredibly high. This, combined with the intense competition for frontline workers, leads to elevated hiring costs. They estimated about $11,196 per associate, and, more importantly, it can negatively impact store operations and customer service levels if stores are consistently understaffed. Now, while Casey's has demonstrated exceptional skill in managing its labor hours efficiently, it is absolutely not immune to these powerful industry-wide turnover forces.
Okay, those are pretty universal challenges for retail and service businesses right now. But you mentioned something even bigger earlier, potentially existential. That secular shift towards electric vehicles. That sounds like a truly long-term game changer that could fundamentally alter their entire business model.
It is arguably the most significant long-term structural risk and potential opportunity facing Casey's business model. The widespread consumer adoption of electric vehicles, or EVs, whenever it fully happens, will inevitably lead to a structural long-term decline in demand for gasoline.
Which is their biggest revenue product and primary traffic driver today.
Exactly. So this is an undeniable fundamental threat to a core part of their current business. However, it also presents a potentially substantial opportunity.
How so, if people aren't buying gas?
Because EV drivers require charging infrastructure, right? And the average dwell time for a DC fast charge, the really quick ones, is estimated to be somewhere between 15 and 40 minutes.
Which is way longer than the 5 minutes it takes to fill a gas tank.
Way longer. This extended customer presence on their property creates a powerful opportunity for convenience stores like Casey's to drive significantly higher sales of those high-margin items. Food, beverages, merchandise, get them inside the store while their car charges.
Captive audience for longer.
Potentially. And independent studies have already shown that retail locations equipped with EV chargers tend to experience increased foot traffic and larger average basket sizes per visit. And Casey's is aware of this. They are proactively preparing for this shift by rolling out EV charging stations across their network already.
Okay, so the big question is, can that potential increase in inside sales from EV drivers truly offset the inevitable decline in fuel profits over the long run? That feels like a massive strategic pivot they have to execute perfectly, not just a minor adjustment.
It is the central long-term question for Casey's and, frankly, for the entire industry. Can the incremental profit from potentially higher inside sales to EV drivers fully offset the eventual decline in fuel gross profit dollars? This is not a simple binary risk. It's a deeply complex operational and capital allocation challenge.
Why complex? Just install chargers, right?
If only it were that simple. The installation of those DC fast chargers is highly capital intensive. Some retailers have estimated the costs at anywhere from $1 million to $1.5 million per site.
Per site? Wow, that adds up fast across 2,900 stores.
It absolutely does. This will require significant long-term shift in Casey's capital budget, potentially competing for funds with new store construction and M&A. And furthermore, think about their rural footprint. The electrical grid infrastructure in many of Casey's core rural markets may be less robust than in major urban areas.
Meaning, it might not be able to handle banks of high-powered chargers easily.
Potentially. It could increase the cost and complexity of installing the necessary high-powered charging equipment in those locations. So, successfully navigating this entire transformation, the capital allocation, the operational changes, the grid issues, will be the defining challenge for Casey's management over the next decade and beyond. And it directly ties back to why their strategic investments in food and digital today are so critical. They're laying the groundwork now to capture that EV customer tomorrow.
That's a huge undertaking with a lot of uncertainty. Are there other company-specific or maybe competitive risks they face beyond the big macro and secular shifts like EVs?
Yes, a few others worth mentioning. Competitive intrusion is intensifying, as we discussed, even in their rural strongholds. Those dollar stores and mass-market retailers are expanding their convenience and grocery offerings, chipping away at the edges.
Right, more competition popping up locally.
There's also acquisition integration risk. It's inherent with any large-scale M&A, like that recent Fikes-Tufit transaction. A failure to successfully integrate the acquired company's systems, their supply chain, maybe even their corporate culture, could result in an inability to achieve those projected synergies we talked about. And that would be a definite drag on financial performance and shareholder returns.
Big deals always carry big risks.
They do. And finally, while Casey's rural focus is a key competitive strength, it also creates a unique kind of vulnerability. The local economies of many of its core markets are heavily dependent on the American agricultural sector.
The farm economy.
Right. So a significant downturn in the farm economy, may be caused by low crop prices, severe weather events, adverse trade policies, could disproportionately reduce consumer confidence and spending in its key operating regions, perhaps more so than in more economically diversified urban and suburban markets where other retailers might be focused.
So, despite their exceptional operational track record and smart strategies, they're certainly not immune to these major forces shaping the economy and the industry. Their ability to adapt, especially to that EV transition, truly seems to be the core of their future story.
Precisely. Their ability to manage these external pressures and navigate these profound secular challenges will ultimately dictate their long-term success and their final place in the evolving retail landscape.
Okay, so given everything we've discussed now, the incredible strengths, the disciplined operations, that powerful flywheel, but also these significant challenges and risks, how is the market actually valuing Casey's right now? What's the price tag say? And what does that tell us about what investors expect for the future?
Yeah, the market's valuation of Casey's is, well, it definitely reflects its recognition as a high-quality operator, no doubt about that. Sure. But it's also pricing in some pretty significant future growth, which creates this fascinating tension for investors.
Okay, so what are the numbers? What multiples are we looking at?
Let's look at the multiples-based valuation. As of, say, August 2025, Casey's was trading at a trailing price-to-earnings, or PE ratio, of approximately 35.7x.
35 times earnings. That sounds pretty high.
It is relatively high. And its enterprise value to EBITDA, or EBITDA multiple, was also elevated, around 18.5x. These multiples represent a significant premium, not only to the broader market, but especially when you compare it to its closest public competitor, Murphy USA, MUSA.
Right, you mentioned MUSA is more fuel-centric. How stark is that disparity in valuation?
It's quite stark, actually. MUSA, operating that more fuel-heavy business model, trades at a substantial discount. Its trailing PE was around 15.0x, less than half of CASY's, and its EBITDA was around 9.5x, again, roughly half.
Wow. So the market is paying twice as much for CASY's earnings and EBITDA compared to Murphy's.
Roughly, yes. This wide gap really underscores the market's willingness to pay that significant premium for CASY's superior inside store business, its proven growth algorithm, and its powerful brand, especially the food component.
It's pricing in that QSR aspect we talked about.
It seems to be. Furthermore, CASY's current valuation multiples are also sitting at the higher end of their own historical trading range. For instance, that EV/EBITDA multiple expanded significantly, going from around 10.4x back at the end of fiscal 2023 to over 18x more recently.
So the stock got a lot more expensive relative to its earnings pretty quickly.
Exactly. This rapid multiple expansion suggests that investor expectations for future growth and profitability are now exceptionally high. There's a lot of good news already baked into the stock price.
So the market is definitely giving them a gold star, maybe multiple gold stars, for their food business and overall execution. It truly recognizes they're not just another gas station. Is there also maybe a hidden value in their assets, that real estate we discussed, that also contributes to this premium valuation?
Absolutely, that's a great point. This leads us nicely into the asset-based considerations. CASY's strategy of owning the vast majority of its, 2,900 locations,
Right.
that provides a really strong, tangible foundation of asset value.
The $4.7 billion book value number.
Right. As of July 2024, the net book value of its property and equipment was recorded at $4.7 billion. However, remember, book value is based on historical cost less depreciation. It very likely understates the current market value of this extensive real estate portfolio, possibly by a significant amount.
Any way to gauge that market value?
It's hard to do precisely for the whole portfolio, but
Yeah.
the high quality of these assets is definitely evidenced by individual market transactions when they do occur. For example, I saw a single CASY's property that was under a triple net ground lease, meaning CASY's pays almost all the expenses, was recently listed for sale at a very low 4.75% capitalization rate.
And low cap rate means?
Low cap rate implied a very high valuation for the underlying real estate asset itself. Investors are willing to accept a lower annual return because the asset is considered safe and likely to appreciate. So while the total net assets on their balance sheet stood at $3.5 billion as of April 2025, the underlying market value of the real estate alone could be considerably higher, providing this tangible measure of value and, as we discussed, a strong collateral base for financing their growth.
Okay, so that's a powerful hidden asset, a solid foundation of value that might not be fully reflected in the usual earnings multiples. How does that sum of the parts idea you mentioned help investors make sense of this premium valuation then?
Right, the sum of the parts, or SOTP, framework. It provides a useful conceptual way to think about and potentially justify this premium valuation. The approach basically involves assigning separate valuations to each of the company's distinct business segments, as if they were standalone companies.
Okay, so how would that work for CASY's?
Well, conceptually, you could value the fuel segment on a multiple, similar to that of a traditional fuel distributor and retailer, like maybe Murphy USA's lower multiples. Then, the prepared food and dispensed beverages segment, being a high-growth, high-margin business, could arguably be valued on a multiple more akin to a successful quick-service restaurant chain, which typically command much higher valuations than traditional retailers or C-stores.
Because the growth and margins look more like a restaurant's.
Exactly. And then, the merchandise segment could be valued somewhere in between, perhaps in line with traditional convenience or grocery retailers. So this SOTP framework helps explain the company's overall blended valuation. The market seems to be implicitly applying a QSR-like higher multiple to that earnings stream coming from the fast-growing, high-margin PF&DB segment. And when you blend that with a lower multiple for the fuel segment, it results in that overall premium valuation compared to pure-play fuel retailers.
So the market is essentially seeing them as multiple businesses rolled into one and valuing the high-growth, high-margin food part much more aggressively.
Okay, what's the final synthesis of the valuation then? Putting all together the bullish case versus the bearish case for the stock at these levels.
Okay, let's synthesize. From the bullish perspective, the current premium valuation is seen as justified. Why? because Casey's is arguably a best-in-class operator. They possess that defensible moat in rural markets, a clearly superior business model driven by that high-growth food component, and a clear executable strategy for continued unit growth and market share consolidation. Add to that their consistent delivery of strong financial results and a shareholder-friendly capital allocation policy. Bulls argue all that warrants a premium multiple. They've earned it.
Okay, makes sense. What about the bears? What's the pushback?
Well, from the bearish perspective, the current valuation with that PE ratio near 36x and an EV/EBITDA multiple over 18x appears to price in basically flawless execution going forward. It leaves very little margin for error.
High expectations mean high risk if they stumble. Precisely. The company faces those undeniable long-term secular headwinds from the EV transition, plus potential near-term macroeconomic pressures on its core consumer base. So any material slowdown in same-store sales growth, or maybe a significant compression in fuel margins, or perhaps higher than expected costs for that EV rollout, any of those things could potentially trigger a sharp contraction in its valuation multiples. The premium could evaporate quickly.
And you mentioned it's trading above analyst targets.
Yeah, the stock was recently trading well above the consensus analyst price target range, which seemed to be clustered between roughly $467 and $500 per share. That suggests that much of the optimism might already be reflected, maybe even over-reflected, in the current stock price.
So it boils down to a great company, but potentially a demanding valuation.
That's a good way to put it. The central debate over Casey's valuation today is probably not about the quality of the business itself, which is widely recognized as excellent. It's more about the terminal value assigned to its fuel segment in a world that is steadily, albeit perhaps slowly, transitioning away from internal combustion engines.
How much is that fuel business worth long term?
Exactly. The current high valuation multiple strongly implies that the market firmly believes the growth and profitability of the inside store business will more than compensate for the eventual, inevitable decline of the fuel business. So any data point that seriously challenges this core assumption,
Like slowing pizza sales or QSRs fighting back harder.
or slowing inside sales growth, intensifying competition, maybe higher than anticipated capital costs for that EV charger rollout, any data like that could potentially serve as a catalyst for a significant re-rating of the stock, likely to a lower multiple. The market is betting heavily on that inside store growth trajectory continuing unabated. So wrapping things up, what's really fascinating here is that Casey's is, I think, undeniably a high-quality, exceptionally well-run company, no question about that. They've strategically built this strong competitive moat by focusing on those rural communities, and they are clear leaders in evolving the whole convenience store model, particularly with their sophisticated and very high-margin food program. Their financial track record is robust, demonstrating consistent growth and impressive margin expansion. And their capital allocation strategy appears disciplined, balancing growth investments with strong shareholder returns. But connecting this to the bigger picture, the market, as we just discussed, is pricing in near perfection at current levels. And the most profound challenge, the big shadow looming, is that secular transition to electric vehicles, which is simultaneously both a significant opportunity to capture a new, potentially high-value customer spending more time at their locations.
Yeah. And also an existential threat to their largest revenue segment, the gasoline business, which has historically been their primary traffic driver. This isn't just a minor tweak. It's a transformation that will require significant capital investment, tremendous operational agility, and a really clear strategic vision to fundamentally redefine what a Casey's convenience store even means in the future. Yeah, that really crystallizes the whole story. And it raises, I think, a final important question for you, our listener, to ponder. In a world where convenience stores are clearly no longer just about gas and a quick snack, where they're actively competing head-on with restaurants and even grocery stores, how effectively can a company like Casey's truly transform its core identity? Can they successfully complete that massive pivot from being seen primarily as a fuel station that happens to have a pretty good kitchen to being perceived as a full-fledged food destination that just happens to offer vehicle charging as well? It's a truly fascinating evolution to watch unfold in the years ahead. Thank you for joining us on this deep dive.